The global economy, I would say, is pretty flat. There's moving parts. Of course, if you look at the U.S., the cleanest shirt in the laundry basket. However, even the mighty U.S. economy, which was growing over 3% last year, saw its GDP growth throttle back to 1.6% in the first quarter. So things in the U.S. are cooling off. Europe is actually surprisingly doing a little bit better. For the most part, another recession was averted, and that's the good news. However, the economy there is pretty stagnant. Japan, I would say, again, pretty stagnant. China seems right now to be printing a little bit better data. However, their economy is still really struggling under the weight of the lingering property and debt crisis that's going on there. So, you can pick and choose, other parts of the planet. In Europe, for example, Spain, Portugal, and Italy, the basket cases that we talked about every day a decade ago, they seem to be outperforming, the core, France and Germany. And, you've got India, which is seeing tremendous productivity-led growth. So you have some areas of the world that are showing some panache. Canada, of course, I sit here in Toronto. Canada has this allure of positive growth, although it's anemic, it's less than 1%. But in the context of 3% population growth, real per capita GDP in Canada is actually contracting at an epic 2% annual rate. So uneven, some areas doing better than others. India is still red hot. But outside of that, very uninspiring global economic backdrop right now. You've got some markets that truly have secular tailwinds. I mentioned India before, and the market is trading at lofty valuations, so a lot of the good news is priced in. However, Modi, might be a divisive nationalist leader, but what he's done, he's pulled a Reaganomics when it comes to a lot of the structural changes taking place in India. So, you have 8% growth that's being fueled by productivity, which is why they're having tremendous growth and declining inflation. It does sound like what the US experienced in the 1980s for anybody that remembers that period. Japan is consolidating right now, but after a phenomenal year, it's still one of the best stock markets year to date. And we're seeing the last leg of Abenomics, the structural reforms taking place, the pressures from the regulators on the corporate sector to remove idle cash and return it to shareholders. When you look at Japan, you're seeing the all-in yield, dividends, buybacks amongst the most alluring on the planet. Those are some critical areas that are doing very well. Europe, very interestingly enough, Europe having averted a recession and averting an energy crisis. That's been a tremendous, actually, people don't talk about Europe actually outperforming the S&P 500 this year. And of course, part of that is the fact that you had a lot of bad news priced in, and the bad news did not happen. But their market is like trading at historically low multiples, so they're a better valuation play than in the United States. Of course, when I get asked the question about my view in the stock market, and I didn't start off with it, invariably that's all people talk about is the S&P 500. But from my vantage point, it's become a very speculative market, and it's trading at a 21 forward multiple. And so unlike Japan, where the multiples are high, but you're competing against bond yields that are 1%, I see in the United States, the front end of the curve, almost 5% yield, the 10-year note, well over 4%. The bond market is trading actually very attractively relative to equities for the US stock market. So I still think that although the best companies in the world are populated in the S&P 500, of that there's no doubt, they're just right now not the best stocks. If you're a global investor and you're looking for relative value and true secular tailwinds, there's other places in the world to park your money in the equity market than the US right now. Look, we have a very highly concentrated market, that's still dominated by a handful of stocks, but, you can always buy sector ETFs. When people say to me, so I talk about the S&P 500, I talk about it in a global context because I've been recommending for some time that investors take their terrific profits in the US and deploy it to other areas of the market that have lagged behind and trading at better valuations that actually, tell you the truth, also have greater secular tailwinds. And Japan has done better than the S&P 500. People tend to forget that. We're so myopic in our view. And when I get asked this question about the stock market, it's just a synonym for the S&P 500. But there's another 60-70% of the stock market out there globally that you can look at. Europe. And when I poll my clients, nobody knows that old Europe has outperformed the S&P 500 this year. And I have to show people my Bloomberg screen to prove it to them. They have no idea. And look what's happened very recently, and we've written about, is the Hang Seng, Hong Kong, which is the poster child for emerging Asia. And what's happening is there's some regulatory changes taking place there as well that is providing more liquidity for their marketplace. And Hong Kong, which was dead in the water just up until about 2 months ago, is back into an official bull market and now rivaling year to date what the S&P has provided. So they're trading, the Hong Kong market's trading with an 8 multiple, which by the way was where the S&P 500 was trading, an 8 multiple in August 1982. And I'm pretty sure, and you would not have convinced anybody back then, that August 1982 would have been the launching pad for a 2-decade secular bull market. So there's other things in the world that are happening where I think that there's no such thing as a sure thing in this business, no guarantees. But there are other areas of the world that have, I think, better valuations and better tailwinds. So I am not against the stock market one bit, but I don't choose to invest in overvalued, inflated assets within any country. The recession call in Europe looked a lot more ironclad than it did in the US. Now look, their economy, they just printed their latest GDP numbers for the first quarter, and good Lord, if you print a number like a 1% annual rate growth in Europe, it's like break out the champagne. I don't know how you say it in French or German or Spanish, but 1% growth, the new normal is like, that used to be what 4% was decades ago. So yeah, I think Europe, and that's showing up in their stock market, because the stock market will always react to what is being priced in. Europe has definitely been an upside surprise, and now the ECB is going to be cutting rates next month. I think what's happened in Europe is their inflation rate has come down dramatically, and the ECB is sounding a lot more dovish than the Fed. They have a super duper competitive exchange rate with the euro, like 107. I mean, you and I both remember when the IPO for the euro back in 1999 was 117 and change, or 107. So they, much like Japan, Europe has lower rates than the US. They have a central bank that is less bellicose than the Fed. And I'd have to say relative expectations have been an upside surprise there. So to get that out of the way. Now, as far as the US is concerned, I think you're quite right. The recession call got jammed up, and got jammed up by what? Well, for example, the budget deficit last year exploded by 25%. You had really unanticipated fiscal stimulus, and a lot of that were those Biden subsidies to the industrial sector. In fact, what was fascinating in 2023 was that the construction of manufacturing facilities ballooned 60%, not 16, 60%, in the same year where industrial production was negative. So we're building all these facades, we're building these factories because of Bidenomics, and there's been no production. It's like we've created this Potemkin village, and we'll see the extent to which the production follows suit. But right now, these are empty manufacturing facilities, but it created a boom in industrial construction. Industrial construction was a hallmark of growth last year, and that was basically the Biden subsidies. In fact, the fiscal stimulus last year wasn't even so much on the spending side. We have enough of that. But how often in the past have we had, say, 6% nominal GDP growth, which is what we had last year, and yet government revenues were down 7%. Normally, a 6% nominal GDP stream will generate an 8% revenue stream for the federal government. Because of those massive subsidies, government revenues for the first time ever were down. You would have thought, looking at the revenue numbers, that we had a horrible recession last year, but that was the fiscal stimulus. Those were the subsidies at play to generate that economic activity on the industrial construction side. Non-residential construction boomed last year. So that was a big part of the getting jammed up on the recession call. What else? Well, we had the last leg of the excess savings file kicking the U.S. consumer into an elevated gear. And this came as a big surprise, especially to me, because history shows, and maybe we shouldn't be relying on history anymore, because as narcissistic as the U.S. consumer's always been, you're talking about a 3 standard deviation event. That, when Joe Biden was told by his economists in the opening months of 2021, go big or go home. All the academic research showed that when the U.S. household sector is confronted with a stimulus check, they save half and they spend half. This is $2 trillion in one fell swoop. We all won the lottery. No matter your income, no matter if you had a pulse or not, no matter who you are, you got a stimulus check, but it was so damn big, you couldn't possibly spend it all at once. Well, historically, the household sector spends half and saves half, but not this crew, not today's household. All of it got spent. The rest of it got spent last year. And that was a big part of the ongoing strength in the consumer. It wasn't about jobs, wasn't about organic income, it was about the continued drawdown of those excess savings. And then on top of that, what happened that I certainly didn't anticipate was that we were going to get double-digit growth in credit card balances. 10% growth in credit cards. We've reached a situation now where the average American household has 4 credit cards. Never happened before. Dad has a credit card, Mom has a credit card, Janie has a credit card, and Fido the dog has a credit card. And so that was happening as people who were starting to see that they had spent the last of the stimulus checks then resorted to credit cards, notwithstanding a 25% interest rate on those unpaid balances. And so it is interesting because we could see the quality of these debts because the delinquency rate, and we're not talking about the 30-day, the serious 90-day delinquency rate on credit cards has gone up to where it was in 2011 when the unemployment rate was 9%, not sub 4, which tells you something. And now we're talking about a $1.3 trillion liability. This is as big as subprime was, back in 2007. And I think we should ask ourselves the question, how is it that we could have a delinquency rate this high with the unemployment rate this low? But when you look at the data and you look at the government sector last year and the expansion of the deficit, and then you apply the traditional multiplier impact of that on the economy, and then you weigh in the last vestige of the excess savings file and the boom in credit card borrowing, and that was 100% of the growth in the economy last year. 100%. So the recession call, what stood in the way of the recession call? Fiscal stimulus, the last vestige of the savings drawdown, and this incredible boom in credit card borrowing and spending. And that's your story. That's how we averted a recession. There's something else that I didn't mention that deserves some attention that comes down to the drawdown of the savings rate to these levels that we actually had back during the housing boom in 07 and the dot-com boom in 99-2000. You tend to get a savings rate drawdown of this magnitude. I never said it was unprecedented. It was just extremely rare, but it happens after an asset price boom. And that's what we've had between the equity market and the housing market. And don't forget that house prices are going up for the wrong reasons. They're not going up because demand is strong. They're going up because there's no supply in the resale market. So even if you have weak demand with no supply, prices can still go up. This isn't the same thing that happened in the mid-2000s when it was really demand-led. This is a very unusual situation. Home prices going up at a 7% annual rate after a 525 basis point rate cycle is, that's enough to cause your head to spin. But look at the stock market. So in the past year, the amount of net worth, the amount of the value of wealth on household balance sheets has mushroomed by almost $12 trillion. That's like half of GDP got lopped onto household balance sheets just in the past 4 quarters. So everybody is feeling wealthier. Well, I guess not everybody. Whoever owns assets, you feel wealthy. And so you're looking at your 401ks and you're looking at your stockpile of assets and you're looking at your house and your vacation home and your equity portfolio. So you say, well, why shouldn't I spend more of my income because my stash of assets are going to look after me in my old age. So why bother saving? And so there's that part of it too. It always seems to happen as classic peak of cycle, right? Like when you start getting the unemployment rate with a 3-hand, and we've been there for some time, and you get the savings rate with a 3-hand, that is very, very late cycle. Very late cycle. When the savings rate is like 10% and the unemployment rate is like 5, 6, 7%, that's when you built up a lot of spare capacity and you got a long runway for growth. Well, we don't have that right now. When you get a 3 handle on both those indicators, you are bumping against a wall. I guess you can call me stubborn. I'm not throwing the recession call away. I've admitted that I was wrong last year. I'm wrong for these reasons. A lot of those reasons are non-recurring. So I'm saying delayed is not derailed, which, by the way, are the words I was using back in 07 into 08 when the same questions happened in 07. Where's this recession already? Next thing you know, it's starting at the end of 07, but it took a long time, and there were things getting clogged in the way then too. There was the elongated cash out refinancing craze and mortgage equity withdrawal. There was still that last vestige of all the wealth created by the housing market. You had Alan Greenspan and Ben Bernanke saying house prices never decline on an annual basis. Don't worry, be happy. The problem is subprime will remain contained. Don't worry, be happy. And so, there was that other aspect of, I'm looking at my McMansion, and why would I bother saving any money? And people drew down their savings rates right up until the point where they couldn't do it any longer, and that started at the beginning of 08. So all the people in 07 saying, where's this recession already? Well, they stopped asking that at some point in 08. You brought that up before in your opening statement. You said, well, this doesn't look like there's a recession in 2024. I'm not so sure about that. We have not seen all the damage from what the Fed has done. And the Fed is not getting ready to cut rates. And we have one hell of a corporate debt rollover. It's 100% true. All these homeowners that locked in at those rate lows, they're good. They're good. They're prisoners in their home. They can't refinance, or else they're going to pay a 300 basis points extra. So they're prisoners. That's why there's no supply. That's why home prices are going up and screwing all the renters or kids living in their parents' basement. They can't afford to buy a home. But the corporate sector, well, they're facing a $7 trillion debt refinancing at rates that will be on average 300 basis points above the origination between now and 2027.